Good afternoon, everyone, and thank you for joining us today. My name is Tara, and I will be moderating this afternoon's webinar. Thank you for joining us for the Automotive Industry Response Panel. Please be advised that we are welcoming questions during and after the webinar. If you have a question, please utilize the chat feature in Zoom. You can either send your question to the group chat or choose to send me your question privately. We will address specific questions to the content covered during the presentation and hold more general questions until the end. Today's webinar is hosted by Rosenfield and Company and Aaron Fox. We also have 3 dealer panelists across the country joining in the conversation of crisis management and their perspectives. Our panelists today are Kenneth Rosenfield, Managing Partner of Rosenfield and Company, Bob Morrison, Partner and Firm Leader of Business Advisory Services for the Rosenfield team. And from Aaron Fox, we have Aaron Jacoby from Los Angeles and Russell McRory from New York. Dealer panelists joining us today are Hank Sames, Brian Terrell, and Russell Geller. Again, any questions you have during are welcome. Go ahead and utilize that chat feature. You should all have a chat message from me already to get us started. And with that, I'd like to turn it over to Brian, as he is going to get us started on the impact of things in the dealerships. Brian?
All right, I'm from Cheyenne, Wyoming, and early on, you know, our biggest concern was if we were going to be shut down or not. We were, you know, in the essential business, and we contacted, you know, the local municipalities, the city, county, state, just to verify we were going to be open, and we started modifying some of our work hours. We cut an hour each day, you know, in early March, and then kind of prepared, you know, for the unexpected, but pretty much kept going every single day. We just grinded it out, and it was slow going at the very beginning. Then the state to the south of us closed down, and we shifted our advertising dollars down there and started bringing people up. And it's actually having in late March, early April, we were having to buy inventory. We started losing inventory pretty quickly. It wasn't being replenished. And then, you know, that as April progressed, it wasn't that bad. You know, Wyoming's a small state. There's only 500,000 people in the whole state. And we didn't get impacted as big as like Denver or New York or Florida. So we did the things that you were supposed to. We already social distance. We cleaned everything. We just made sure that people, when they were at work, they were healthy, and went back to the basics. And we were fortunate. We never cut an employee. We never laid off anybody. We just kept going right through. And now today, we're about out of inventory. We normally stock about 180 Chevrolets. We have 37 on the ground. Normally stock about 150 used cars. We're right at about 38 used cars, 1 truck. So it's been devastating towards the end you know, here towards July. Normally our busiest time of year, we're pretty much out of business now with no inventory. Service has been really good. Service department's been good. Parts been good. The biggest effect that this whole thing's had on us has been in our body shop, and with the claims. The adjusters wouldn't come out and adjust these vehicles, so our body shop was pretty much shut down for 2 months. Fortunately, living in Cheyenne, Wyoming, we've had several hailstorms. That's kind of forced them to get out, the insurance adjusters get out and start adjusting these cars, and we're back, our body shop's back fully going. We should have a very good month in July in our body shop. Other than that, we've been profitable every month, and just focusing on keeping people on the right track of, you know, social distancing, keeping everything clean.
Sounds great. Thank you, Brian.
Yep.
Hank Sames in the Texas area. You can give us a little update on what's going on in your neck of the woods.
Yeah, we operate in 3 different markets in Texas, so each one's a little bit different. We operate in Laredo, Texas, the Corpus Christi area, and the Austin area. The worst performing is the Corpus Christi area because of the oil. They're heavily dependent on oil. The other 2 markets not so much, but we had terrible March. Well, March wasn't terrible, but it was not great. And then April was terrible. And then, believe it or not, May and June were pretty much record months, not so much in volume, but in profit and bottom line. I think all the dealers are suffering from inventory shortages, and I do think that's going to be alleviated a little bit. The manufacturers are back in business now, so we should start seeing some inventory roll in. And we've actually seen a few convoys start to roll in. But some of the things we've done, our dealerships, we have 9 dealerships, and we felt like communication was the main key to our dealership. So we did a video early on for all employees that told them what our take was on this situation, what we thought we had to do to survive. We told everyone we didn't want to lay anyone off. We didn't do that, but we did. We originally instituted a 10% pay cut across the board with the owners taking a 50% pay cut. After the PPP funds became available, we reinstated everyone. And what we did for commission people, we told all the commission people that we would pay them their average of the previous year for 3 months. We did that for 3 months. And now everybody's back on their regular commission plans. We asked all of our vendors for a 15% discount. Almost all of them did it. We reduced rent by 10% for 3 months at all locations. And we also instituted a no questions asked $500 employee loan for employees that were impacted. Some people just had expenses that they needed to take care of, and so we did that. Not that many took advantage of it, but we had, some. Sales initiatives, we focused on gross instead of sales. We started that early on, and that we've seen a huge benefit to that. I think that's the reason we had record months in May and June, was because our grosses in really all departments were very good. We worked on perfecting online platforms. We created a home delivery solution and home sign-up solution. Believe it or not, there wasn't as much online buying as we thought. We found a lot of people will start online, but they still want to come in, to the dealership. We're all faced with inventory shortage, especially on used cars. Used cars are just really hard to get right now. And they go real high at the auction. But a bank's only going to finance what the book value is. And if you buy it for over book value, you're going to have a problem selling it to the customer and getting it financed. One thing we're doing, we're just getting it rolled out, is a used car consignment program where we're going to try to we're advertising and we take all the hassle of selling your car away from them. We charge a flat fee of, I think, $400 and a 7% commission on selling the car, with the expectation we'll make money on the back end of that. We've actually started it and have a few customers that have already come in, so we'll see how that does. As far as service department, we're advertising sanitation process for customers' cars, and our service department has really done fine. Where we see the decrease is in internal parts and service sales, because we're not getting the used cars that we would normally service, internally. And we've done a lot of sanitation. We purchased a disinfecting pressure mister that disinfects all of our service vehicles and other vehicles. We hired a weekly professional sanitizing team to come in and sanitize every week our dealership. We started a mask policy from day one, and recently we've implemented a COVID system screening that employees have to fill out prior to clocking in for work, and also it includes a temperature check. So that's how we're doing it. We've had about 50 employees out of 500 come down with COVID, and so we've had to do workarounds. You know, when you lose one, it's not just one, because then you have other people you want to quarantine. Tell them not to come to work. That's been kind of tough, but mainly what we do is I think the two most important things you can do right now is communicate as much as possible with your employees. We're having weekly meetings with all of our managers via either Zoom or conference call. And the other thing is, I think it's really important to put out fires as they come up, and I mean put them out quick. You know, you have a situation come up, don't let it turn into something large. And that includes things like, you know, you have employees that get real nervous about the whole situation. They read too much or they hear too much, and all of a sudden they're panicking, and you got to put that kind of thing out really quick and communicate with them, take care of them, make sure they know that you're listening to them. That's what I got.
Sounds great. I especially love that no questions asked loan. That's a really unique thing. I think that's special for you guys to do.
Yeah, we felt like, you know, we asked them for a 10% pay cut, which we didn't actually do because the PPP money, thanks to Ken Rosenfield, who helped us with that. When we got that, we didn't feel like we needed to cut the 10%, but we kept the employee pay loan, and that, you know, we've had some people with emergency. We don't even ask, you know, they come in, they want it, they can get it. It's $500.
Makes sense. Well, that's great. Thank you for that update. That's very insightful information for us. And last but not least, dealer panelist Russell Geller from the New York area. You could give us a little update on how life is going there.
Well, life is finally beginning to somewhat normalize. I live in a town called New Rochelle, which is about 15 minutes from my dealership, which is in Yonkers, New York, about 15 minutes north of New York City. New Rochelle, New York was one of the original hotspots in the country, so we've been in the thick of it since late February, early March. The governor of New York immediately shut down all businesses in New York, and we had very tight constraints. As he quoted him, he flattened the curve, and now we see the curve increasing around the country. But we were essentially out of sales business from mid-March through late June. We did, through the support of our local car association and state association, get service deemed an essential business. So service was flowing. We did have to furlough the entire sales department, majority of the office, since parts and service were the only allowable people in the building. We're now back online. We had a 4-step process to reopen our businesses. We have very strict requirements here in New York. We have to file a report with the state. We have all the cleaning procedures, the masks. We started our sales business with online appointments and trying to sell cars online, which of course, being a native New Yorker, is very difficult. New Yorkers are extremely difficult to deal with in person, yet alone online. We finally morphed into taking appointments and having them come into the dealership via appointment. And as of the last 2.5, 3 weeks, we are now fully opened in the dealership. It was very difficult to furlough the entire sales department, half the office, some technicians. Interestingly, I reached out to our union, got them to support the business. We relaxed the guarantee in the shop. The RO count was off up to 50% in the very beginning. Our sales were off up to 80% in this area. I'm also experiencing the same difficulties in inventory. Inventory is getting tight on new cars. The pipeline is getting reduced. Whatever was built or to be built is either in or already built. The allocations are very tight. We're fighting all the other dealers around the country for it. The wholesale prices of used cars are through the roof, the same difficulty. You pay too much for the car. You can't get it financed. It's just been incredible to see what other parts of the country are now experiencing. And here in New York, we've already lived through what's been really bad. New York now, in addition to Connecticut and New Jersey, which makes the tri-state New York area, we have a list of 31 states that are now on a quarantine list. If you come into this area, you have to quarantine for 2 weeks to protect the health and what was done here in the New York area. Once we burned our way through the PPP funds, I'm now giving a closer look to payables and receivables. I would ask everybody who's running their own store to take a look at that. My receivable is manageable. My payable is manageable, but the receivable seems to be a lot higher than the payable. And of course, the general excuse is Corona money and such, just as I'm trying to balance how the bills are being paid here. So we've had a lot of good vendors who are working with us as long as we pay some older bills and going forward that we have experience with. And then of course, there's some people or some vendors who completely lost their mind, threatening cutting off of credit, lawsuits and such. We all know the courts aren't functioning fully. That's just bad business. I mean, we're all in this together, and we all have to work our way out. And, you know, cash is usually king. Nobody's sitting on a ton of it these days, and most people are respectful of it, and that's what we need to continue to do. My staff has been really working well. We screen them with the questions beforehand. We take temperature. We log everything. It seems that in New York also, the regulatory agencies try to make examples of dealers. So we have to keep all the records. There are instances of dealers in the New York City area being dropped in on by whatever agency, and potential fines. I will echo the sentiments of Hank. Communication is key with the people. You know, asking people to take pay cuts and such, very difficult. It started at the top down, including myself. I've been here in the dealership every day since we shut down as supporting the people. If you support the people and they understand, the majority will go along, because we're all in this situation together.
Absolutely. Great insight there, Russell. Thank you so much for sharing. I do have a few questions for the dealer panelists before we move forward with Rosenfield, but I did have a question for the group on how you're expecting the lack of current inventory to affect parts and service volume in the future.
Like I said, it already has affected us with our internal work, not so much retail, but the internal work. And unless we're able to get used car inventory, you know, we're gonna continue to be down in that area.
I would agree with Hank. I don't think the immediate issue will be units in operation, because we do have the current cars on the road. GM even went to the extent of extending upwards 6 months the no charge oil change, because the initial customers were stuck at home. So I don't believe that will happen immediately. Obviously, if we're selling at a lower rate since March going forward, we'll probably see that in the future. But I do agree with Hank. The internal labor is down. That's predicated on used car business. Retail is actually up. The people that aren't wanting to go out and buy new cars are servicing their cars, and they're actually taking very good care of them, better care than they have in the past. And I have seen an increase in the average RO.
Makes sense. Well, thank you. And one last question for each of you, I guess. How is your how are the difficulties now during this crisis differ from those you've experienced during the global financial crisis?
I didn't understand the question. Could you repeat it?
Yes. Can you differentiate the difficulties you're facing now versus those you experienced with the previous global financial crisis?
Well, the finance banking issues are similar but different. At the time, in the 09-010 time period, when the mortgage world collapsed, people that were normally bought weren't getting bought going in the future. Now the finance companies, at least here in our market, they're really taking a deep dive. Some business is better than no business, but once again, wholesale value of the car makes it difficult to get the money that needed to be financed. As I said earlier, cash is an issue. It gets consumed quickly. I would have to venture most dealers are out of PPP money. Will another round come about? Anybody's guess. Where does the money come from? We print it. Money is not backed by anything but the faith of the government and the people who believe in that. It's difficult, waking up every day and trying to figure, can you pay the bills? Can you pay the people versus, the income and the profit that's coming in, if there is a profit?
Well, I think New York is definitely different than Texas, because in Texas, this crisis, it is a crisis, no question, but it's not nearly as bad as it was the financial crisis. Because during the financial crisis, we didn't know if the manufacturers were going to be making it. And I actually had a bank walk away from us, telling us they wanted to get us, for us to repay, not because of our credit, but because they were afraid that the Ford Motor Company was going to go under. And when you're affected like that, it's really tough. And the other thing is, we had a problem with too much inventory. Now we have a problem with not enough inventory.
Okay, thank you. Thank you for sharing. Brian, was there anything you wanted to add to that question? Any differences you're feeling now versus then? Oh, I've unmuted. There you go.
A lot of difference for us from the financial crisis to now. This is a crisis, but we truly haven't felt the impact of it as of yet. We felt it back in 2008, 2009, with the high unemployment, trying to get people bought. It feels different.
Thank you. Thank you for sharing, guys. And with that, I'd like to turn it over to Ken Rosenfield. Give us a little impact on what's going on in the world of accounting. Ken?
Well, thanks. I'll try to be brief. So it was really interesting hearing our esteemed panel talk. And one of the things that Brian mentioned about inventories, and especially with used vehicles, was the cost of being so high. And it was interesting to hear that. Here in Orlando, Florida, it's home to two of the largest auto auctions in the country. So we get a lot of feel for what's going on here in terms of automobile prices and those kind of things with used, and it's through the roof. It's highest it's been in decades. With new vehicle inventory, I just want to go through quickly some of the things some of our clients have tried to do that we thought were fairly creative. Don't worry about making sure this one unit's going to sell, especially when you're getting down to low levels, because they probably will sell pretty quick, and start monitoring the traffic on each unit to see who's buying them, and monitor the credit scores of who's looking for them and the demographics of those customers. And maybe it's the first customer that lands on this car may not be the one that's going to give you the most gross. And Brian was correct too. He said they're going for the gross, and that's made all the difference. It's kind of like the good habits are made in the bad times. So going for the gross is key with all inventories. We've had some clients negotiating trades with some of their other brethren in the same make that they're having. And so maybe certain areas, certain vehicles might sell better than other vehicles. So they're looking at dealer trading and trying to get vehicles and maybe selling off some of their friends' inventories if they're not selling in one area, but might be a little bit hotter in other areas. A big thing is focused advertising. We're seeing a lot of expense cutting in advertising and getting very laser focused on the type of unit. So go after the customers that's going to meet the units that you have. And, there's a lot of data tracking software out there, and to see the movement, if someone's looking at a specific vehicle, look and see what their search history has been, and try to get a little bit more laser focused on who you're trying to reach for what you do finally have in stock. This production's still the lowest it's been in a long time. Look at the paid search campaigns. We have a lot of clients that are just discontinuing their contracts with those and getting out those already because the demand is already there, and match your spending to what you actually have in stock. And look at advertising just specific units to a certain market. So get a lot more laser focused in advertising. And promoting that your vehicles are clean and they're out quickly from whatever they need to get done. We're actually seeing some of our clients, I was at one of our clients last week. Actually, I purchased a vehicle myself that was out of stock. But they were looking at switching wheels, switching radios, and changing around units a little bit to make them maybe a little bit more attractive, or add some gross to other vehicles by switching parts out of some new cars that may not sell because of color or something else. But if they're upgraded with some options, you take them out of there and throw them into other cars. Next slide. With used vehicles being so high, I really like Hank's idea of consignment. That's been a really creative method that we've seen with some of our clients using. It's very effective in some areas, especially trying to get units. And also looking out of the box. We had a client in Virginia that does very well with trucks, but they looked to see this stocking trucks that are a little different than their competitors. So they're going out of market to different areas. So like Virginia, they'd be buying cars out of Nebraska and Idaho and Iowa from auctions out there to bring vehicles in as quickly as they could and selling them off of what they purchased to Virginia, just to have something a little bit different than they would have their competitors. One of our clients has gone into real deeply looking at pouncing on finding low mileage vehicles that get put on the internet by individuals and buying them quickly and trying to put them in the stock as fast as they can. So they're looking at other avenues to obtain inventory through the internet instead of auctions, because auction prices are getting high too, and they think that they might be able to buy cheaper off of other avenues that are on the internet. Getting F&I products sold quickly through technology with pads and trying to work the F&I period of time to much shorter time using technology has also been quite effective for many of our clients. Are getting more F&I income out of being able to sell it better and more efficiently through technology with iPads and other type of technology with their customers while they're actually even in the vehicles. This is also an opportunity to get some more leeway in the market value vehicles for trade-ins, and looking at getting value out of trade-ins and trying to price them correctly as they come in, and giving customers maybe a little bit more under trade than normal, but able to turn around that trade as quickly as possible as well. Another avenue we've seen is credit still isn't that great. Through all this time and working with the indirect lenders to have programs with them to open up a little bit more financing if they get more penetration, and just working better deals with them to increase their sales with the indirect lenders, and maybe partnering with them a little bit more than they have. Next slide. Parts inventory. This is sometimes very neglected. but taking a look and see what items you have that might be slow moving and try to run service specials on parts that are sitting in stock or special order items that came in that the customers are not coming in, but looking at some ways to move parts that way. Working wholesale contacts with smaller venues for parts to unload some parts that are taking up your shelf space. And also looking at developing some incentive plans. Pay plans, we're seeing those change a good bit as well, but running service specials for overstocked and aged parts and taking stock at those and trying to get rid of some of the slow moving parts. Next slide, please. People management's huge. Really, you know, in New York, what Russell Geller's dealing with you have unions and things like that. That adds a whole new dynamic. So what he did with his unions and negotiating with them is spectacular. Things like that there's not many markets that have unions. So dealing with that's a whole new world. And what Hank's done as well has been also extremely creative. But changing the pay plans to gross profits and focus on the gross, and maybe even limiting customer time in the dealership as well, and how quick the service process is, and going after the CSI and increasing the dealership's focus and maybe generating service appointments and things like that with high gross, going to pay plans that reflect that is much less in volume. We're seeing a big change in that. That's also very effective to help the staff make a lot more money than they have been. Training is really going to be key, especially with used vehicles, more sales in used vehicles, getting to know the products better and using some creative type advertising. We've seen a lot more 3D videography in sales techniques, a lot more lead management, and focusing very, very highly on that, and maybe more on some lost souls, and mining your data that you've had as well. Trying to work more towards with the volume of customers coming in service, trying to come up with techniques for selling more service at write-up, getting used to this no contact technology, how that's going to work more effectively and still be customer friendly. And also reconditioning vehicles rapidly, getting them out on a lot as fast as you can has also been a game changer for dealerships that weren't able to get it done quickly before. We're seeing a focus on recon departments trying to get units in, especially if they're coming from farther away or their customers are on consignment and trying to get these vehicles sales ready or getting them ready much more rapidly. Other things is what I call vendor management or vendor capital, is working the vendors in terms of, as Russell said earlier too, we're all in this together, working out payment type plans with them, help smooth out your cash flow. Another thing is also looking at your advertising companies as well as maybe not paying for performance, not just for buying, and looking at seeing if they're really generating leads, just putting leads that are being generated, quality leads that turn into sales, and maybe change the contracts from just outright buying and commissions for buying media or something, but actually looking at paying for how effective that advertising is, taking a look at those kind of contracts. Next slide. I'm going to turn this over to my partner, Bob, now, because I wanted to be kind of brief because we have a lot more to cover. So Bob is going to talk a little bit about the impact on business valuations and value. Go ahead, Bob.
Thanks, Ken. Good afternoon, everybody. Valuations. The one thing we know for certain is that anyone who tells you they know what impact this is going to have on the value of their business, their dealership, they're lying. We don't know what's going to happen. Uncertainty is huge right now. We can only look to tools to try to figure out or get ideas what those values might be. Go ahead on the next slide, Tara. And so a very basic about valuation. We all recognize that the higher the profits, the higher the value. But there's a concept that's often overlooked, and that's risk. And when you get a lot of volatility, which equals a lot of uncertainty, that uncertainty equals risk. And the more risk, the lower the value. And that's kind of an environment we're in right now, very high volatility, which regardless of your profits, even if your gross profits are up and everything looks fine, that uncertainty introduces a lot of risk into an investment in any type of business, and therefore the values are depressed. Go ahead, next slide. This kind of gives you an idea, looking back historically, if the red line, that is a composite of annual returns and the volatility of those returns for, I think they're like 7 publicly traded dealerships. The blue line, that's the volatility of returns of the S&P 500. So just out of the gate, dealerships are more volatile, and this is a security market, public security market. Dealerships are more volatile than the S&P 500. And not surprisingly, the shaded boxes, if you will, the first one's the global financial crisis back at the turn of the decade. And you can see how the volatility spiked during that time period. And then now in COVID-19, the rest of the chart is to be determined, but we can see that volatility again. It is interesting that the volatility isn't quite as high as it was during the global financial crisis. But again, we haven't seen the end of this part of the chart. But I think everybody, and it's common sense, that right now, with so much volatility in the marketplace, it's just very uncertain and very risky. Next slide. So I kind of also want to go back and look at, this is data on all the vehicles, unit sales, year-over-year change. So it's the left, the vertical axis is percentage change year over year in volume and units, and the horizontal axis is time. And if you look in that 1979 to 80 time period, I think we all remember there was a recession during that time period. Bring it forward to 2000, 2001 and the dot-bomb recession. It wasn't quite as deep. Then we go to the 2007, 8, and 9, which is global financial crisis. And we can see where the year-over-year change in units sold was so low, actually decrease. And then what we're experiencing now again, and you all know it better than I do because you experience it daily. This has been kind of your difficulty, your challenge to operate. But this gives you an idea of how that has transpired in terms of units sold over this time period. The next slide, please. Now this slide is interesting, and this really starts getting into the valuation topic. What this slide presents on the vertical axis, it's the percentage of change, either increase or decrease, in unit sales over a base period being immediately prior to a recession. And I use just 12 months prior to the recession. And we're tracking 4 different things. The green line is the 1979 recession. The purple line is the 1989 recession. The blue line is the global financial crisis. And the red line is COVID-19. Now, what this is if you look along the horizontal axis, this is the number of months from the beginning of the recession, the quote recession, or the impact. And you'll note that out in month 67 to 70, all the previous ones had caught back up to their units sold, just about, to where it took them 6 years to catch up to the total units sold. You'll note that the 89 recession actually occurred a little sooner, 55 months. But the question becomes, for the red line, for COVID-19, where does that happen? And that's the valuation question. When do we return to normal? Assuming that, that the number of units sold is indicative of value of a dealership. When does that return to normal? And a couple things that I note immediately. Number one is that the impact, the negative impact from COVID-19 happened a lot quicker than in the other, quote, recessions. It took the other recessions quite a bit to bottom out. You can see they bottom out in the 13 to 22, 23, 24 month period. And all of them, they had what people are referring to as a U recovery, where it isn't a bounce down and up. It's down in kind of a trough for a little bit and slowly come back up. Yeah, and I don't know what happened there in the 25th month of the 2007 recession. You guys may know better than I something that spiked the sale of units. But in any event, it's pretty clear if you smooth these lines out that there's a falling off the cliff in the first 16 to 20 months, and then a slow, gradual return from months 22 to months 60 to 70. Now, in COVID-19, we got this big decline, and if we were able to say we have found the cure for COVID and that's going to be it, I would forecast a quicker recovery in terms of number of months than these other recessions. But again, the problem is we don't know. The story hasn't been written yet. And so part of the uncertainty is what does that red line look like in months 5 through 20, 30, 40, 50? And unfortunately, we don't know. Next slide. Okay, this shows you basically the 2007 recession and when recovery occurred. And it's just taking the 2007 recession from the previous slide and showing you that, by what happens to be 70 to 72 months, 6-7 years, it finally, the number of units sold crossed back over the 0% line. Tara, that's January of 2014, roughly. Yeah, right in there. Yeah, so after about 4 years, it kind of crossed over and then has bounced around above that baseline since then. And so, yeah, if we were to want to, what would a buyer look at? How would a buyer interpret this? A buyer might look to that 2007, 2008, 2009 global financial crisis and see how your dealership acted and behaved as a result of that, and how quickly it might have come back. That's certainly something, if I'm valuing a dealership, that's something I'm going to be looking at. Next slide. Now, we talk about blue sky multiples, and this is all pulled out of the Hague report. And what you've got is along the horizontal axis, you've got the different brands, Porsche, Mercedes, et cetera. And it gives you the blue sky multiple ranges that were reported by Hague for 4Q 2019 and 1Q 2020. And you can see that in all cases, the range of multiples reported by Hague declined, and they declined anywhere from a quarter to a full 1-time blue sky multiple. So this confirms what we know already. The question is, can we now start relying on these multiples as being indicative of value? And go to the next slide. And the answer is no. If you look at the fourth bullet point from the Hague report, that the blue sky method is problematic because the 2020 results are highly distorted. And stepping outside of the dealership industry for a second, in all of businesses, when you start talking about value and multiples, everyone's throwing out the old market method of using multiples because multiples are based on history, and history isn't repeating itself this year. And so the question becomes, how does the impact of COVID-19, how does that impact those multiples? And just some more notes from the Hague report, which again, you all are probably more familiar with than I, the decline in the number of transactions. They believe it's going to take time for the market to recover if there is a market, that the values are down. And this new EBITDA, I think everybody's familiar with EBITDA, earnings before interest, taxes, depreciation, and amortization. Well, now there's EBITDAC, which is before coronavirus. So what in the world do you do with this? Next slide. Well, this is how you would approach determining the value. One is just forget about the whole blue sky concept and base it on expected future cash flows. And in order to do that, you'd have to somehow project out or get an understanding or expectation of how COVID is going to affect your future cash flows and when and if you recover from that. Another methodology being suggested by Haig is using your 2020 income, but using 2019 blue sky multiples. And a final way is using 2019 income, which is unaffected, which is that EBITDAC, and using an adjusted blue sky multiple, so using perhaps the lower end of the multiples to reflect the risk or the uncertainty surrounding COVID-19. But I have the best way to value your dealerships in times like this. Next slide. Either a dartboard or the magic globe. So if you have the magic globe that can tell you with accuracy what's going on, I'd use that. Or if you got a good dartboard, I would use that. In summary, it really is a kind of a toss-up right now. And the question revolves around all that uncertainty regarding COVID, the uncertainty that has even on established current profits. That doesn't mean you're going to be able to sustain that through the pendency of COVID-19. And even probably more so, when COVID-19 goes away, what does that mean? What is the environment when COVID-19 goes away? And again, anyone who tells you they know what the future is going to bring, they're not being truthful with you, because the only thing we know for certain is that no one knows what's going to happen. Thanks, Tara.
Thank you, Bob. And I know for certain I'm going to buy you a dartboard and crystal ball for the office.
Okay.
The only problem with that analysis is that you have to buy, I mean, it takes two people to make a transaction, the buyer and the seller. Very hard for sellers to swallow the idea that they're going to, take less for their store.
You're absolutely right. And so you would question whether there really is a market right now. When we looked, if you want to know what the value of your stock is publicly traded, you go and you look at it, online, and you say, hey, that's the value of my stock. Well, not necessarily, because some of that stock is not actively traded. There's no market for it. And so that value isn't really the value of that stock. Similarly here, you can apply any multiple you want to some income and say, here's the value. But if there's no market for it, then, what is value? The other thought that comes to me based on that comment, Hank, is that now would be a good time to be transferring shares, gifting shares to family members. It gives the uncertainty, gives us a great opportunity to record some discounts and value and move a lot of ownership percentage for a lower dollar.
Funny you mentioned that. My daughter's actually buying some shares and Ken's working on the values.
Yeah. It's a great time to do it. And some of you have said, well, our profits are best ever, which, the IRS would look at that and say, well, wait a second, your profits are the best ever. But the uncertainty of the future, really devalues those current profits or devalues the expectation of profits in the future.
Awesome. Thank you so much, Bob, for that. At this point, I'd like to turn it over to the lovely gentlemen of Arent Fox, Russell McRory and Aaron Jacoby. Oh, I think I've got, there you go.
Now we're on.
All right, perfect.
Well, good afternoon, everybody. My partner, Russ, and I are happy to be here. Oh, it says I cannot unmute myself. Can you hear? Okay. So, Russ, why don't you take it away? We don't have a whole lot of time left, and we'll start off with employment issues.
Sure. Next slide, please. So we're just going to first start briefly about what's going on with labor and employment issues, and especially ones that could lead to litigation. Next slide. So there have been a lot of lawsuits over, as of a week ago or 2 weeks ago, over 2,000 lawsuits related to COVID-19 have been filed. Claims have been involving both employees and customers related to COVID exposure. Workplace health and safety. There's been no federal government action yet to limit COVID-related liability. The Republicans apparently want to do it, but we'll see. Good luck getting that passed in this political climate. The final bullet point about liability waivers, we do have dealers asking us about should we get our employees to sign a liability waiver. We would recommend against that. They're A, probably not enforceable, and B, they look really, really bad. So if you do get involved in a lawsuit and you get your liability waiver thrown out for unenforceability, it's also going to be used as a great piece of evidence against you. So I would maybe, I think we would not recommend trying to get your employees to sign liability waivers. Next slide. So in terms of workplace safety, in the New York area, we have certainly had situations where we've had not only employees coming down with COVID, but unfortunately, some have passed away. And there's what is the liability there? The answer is we don't know. Those lawsuits are coming out. They're still coming. We don't know how it's going to play. As a lawyer, the question is, well, can you prove what we call causation? And the issue is, when you're dealing with a jury, the issue of causation is what the jury decides it is. So the best defense to that type of a lawsuit is to make sure you have all your procedures in place. I know, I think both Hank and Russell Geller spoke about that. You got to make sure your employees fill out the questionnaire every day. They get their temperature taken. There's all the hand sanitizers around, the social distancing, all of those mechanisms that the state has required and recommended, make sure is in place. That is your best defense, because if the plaintiff's attorney is up there and is able to show that the dealer was not implementing those protective requirements, the case is over, regardless of whether that employee contracted it at the dealership or not. Your best defense is going to be your processes, your procedures, and your compliance with CDC and state regulations.
And Russ, if I could just add, just to put a specific point on that, in order to best prepare for that defense, look very carefully at the federal government guidelines, which are from the CDC, your state guidelines, your city and county guidelines, and even at your own policies. One of the major stumbling blocks that dealers can run into, any business can run into, is if you set a policy and it says you're going to follow steps 1 through 10, but somehow you're missing step 7, you will be found negligent if you missed that step 7. So pay very close attention to all of those things: CDC, state, county, city, and your own policies.
Next slide. So the issue of discrimination is rearing its ugly head again. With dealership employees being laid off, anytime there's layoffs, discrimination claims follow. The bottom line is if people are getting laid off, you have to make sure that all the boxes are being checked in terms of that there's no disparity in treatment that there are in certain, whether it's females, whether it's certain races, whether it's sexual orientation. You have to make sure that if employees are getting laid off, it's being done in an even-handed way without any reference to any protected class. There are potential claims under the Americans with Disabilities Act what if you have an employee who's at a higher risk, say that is recovered from cancer or high blood pressure or is overweight. Those employees can request reasonable accommodations. And that would mean no cost or low cost solutions, like allowing those employees to telework whenever possible. Make sure you have your plexiglass up and other barriers. On the one hand, the accommodation doesn't have to impose an undue hardship for the employer, but on the flip side of it, even a little extra expense to take care of things like that are probably well worth it. A lawsuit is always more expensive than a piece of plexiglass or some accommodation made to an employee. So you need to very carefully weigh the costs and benefits, both from a cash perspective and from a public relations perspective. Lastly, you can't prevent employees who are otherwise able to come back from coming back simply because of some physical condition, like, for example, pregnancy, age, obesity. If they are able to return to work and can return to work, and you're offering other employees in similar roles to return to work, they have to be offered the same opportunity. So this is an issue I just want to raise in case, especially for the states that are maybe facing shutdowns. This was a big issue in New York, obviously, some months back, where there were shutdowns. And as Russell Geller pointed out, he had to lay off most of his sales staff, some of his business staff. The WARN Act notices, while there are exceptions to the WARN Act notices for exigent circumstances, for example, if you have, the governor does the shutdown order and you have to send your employees home, that's an exigent circumstance that impacts WARN, but it only impacts the timing of the WARN Act notice. You still have to give a WARN Act notice. So while you don't have to give off in the full 60 days, the WARN Act notice is a requirement. We had many dealers that we experienced that did not want to send out a WARN Act notice because they said it would send the wrong message to their employees. Dealers who didn't do that took a risk that some savvy plaintiff's lawyer who gets a dealer employee plaintiff who can complain they didn't get a WARN Act notice. There's a potential claim there. So if this issue does come up and you do have to shut down and lay off employees, look at your WARN Act notices. And again, while the time frame may be shortened, the requirement of a WARN Act notice does not go away. If you otherwise have the number of employees, the number of layoffs that trigger that, you still have to send a WARN Act notice. Next slide. While this is not a PPP presentation, I just wanted to cover quickly some of the loan forgiveness issues that are arising. Initially in the PPP process, it was about how can I get a loan and how much of a loan can I get? And now we're in the stage of how can I get this loan forgiven? Next slide. So the Department of Justice has already started prosecutions for alleged fraud. These are obviously the cases we've seen in the news, which are pretty egregious kind of a case. So those are getting picked up pretty quickly. I don't think I think dealers tend to be a little more careful. They're a pretty highly regulated industry. They know how to do things the right way. So I haven't seen any dealers in that category of the egregious PPP loan violators yet, but just to be aware of that. But there will be audits, there will be investigations, and it won't just be the loan amounts over $2 million. Well, those are almost going to be automatic triggers for loans, for loan audits. Loan amounts under that will still be audited. Next slide. So what can dealers expect? The PPP loans themselves were subject to relaxed standards. The PPP loans went through the Small Business Administration, but the borrowers did not have to jump through all the normal SBA loan hoops. Especially for dealers, for example, the non-aggregation rules, things like that. It was much easier and quicker to get a PPP loan than a normal SBA loan. But that said, all the normal requirements of being truthful, being accurate, are still there. And I think for the most part, dealers were very careful about that. They definitely, for what I saw, did reach out to attorneys and accountants to make sure they were doing everything right. But just that is always the issue there. There have been dealers that have reduced or withdrawn their applications or returned money. Those have been more not for legal reasons, but more for public relations reasons. There were, for example, the Publix withdrew their applications and didn't take money. Some of the larger dealer groups didn't take money or returned a portion of it. Again, that was more for, I think, public relations than for pure legal reasons. Next slide. So, look, the bottom line, is documentation. Is when you get to the forgiveness stage, you will want to have documented your expenses, documented your forgivable expenses, work with your accountants, make sure that the amounts that you're seeking to have forgiven are fully and accurately documented. Don't do it after the fact, looking around for documentation. Do it as you pay it, and the process should be pretty pain-free. I don't want to scare everybody on the webinar. We've covered a lot of negative things in this portion. The PPP loans were excellent tools. They did what they were supposed to do. people hired. We heard the dealer panelists talk about that when they got the PPP loans, they hired people back, they raised people back up to their old salaries. That's what it was supposed to do. So don't be frightened of it, but just be prepared and just document. Next slide. So the next section Aaron will pass off to Aaron to start out. These are the traditional franchise issues that we see coming up, and actually some of these are very current issues for dealers. Aaron?
Yeah, so what do we mean by traditional franchise issues? They're the ones that we all deal with under state law that have to do with relocations, terminations, add points, et cetera. So what will the focus be now? I think it remains to be seen, as I think Bob said earlier. The story hasn't been written here yet, and some of this will depend on how quickly manufacturers ramp back up. But what do we think the focus will be? First of all, on allocation of vehicles. Second, as time goes on and things get a bit back to normal, facilities. So with regard to allocation, and I think maybe we go to the next slide here. Because there's been such a drop in sales, in unit sales, with manufacturers having shut down, and regardless if unit sales could be up, there are not enough units to support unit sales being at normal levels. So what do we think is happening now? Now, a lot of dealers are experiencing the good news of good grosses, good profit. That's all related to the supply and demand curves we all saw in Economics 101 back when we were in college. And as those curves flatten out and supply starts to equal demand, what will happen next? That's where it's a little bit more unclear. But for now, while it's difficult to get vehicles made and allocated to dealers, we expect that there will be some friction with manufacturers or between dealers and manufacturers as manufacturers are trying to divvy up the limited available inventory among their dealer body. So that's one area that we see some friction developing. The other area is with regard to facilities, and I think we see a bit of that already. So there are OEMs that have moved out their deadlines for compliance with various facilities programs. The Lincoln program of building, an independent, exclusive, ultra luxury experience has been moved out to the end of the year. That's one example that is almost funny given their level of market share. But other manufacturers are doing the same. They're laying off a bit on meeting facilities and other expectations right now. But I think that will ramp up pretty quickly, and dealers will be expected to build to the facility standards that were in place. Why will that develop friction? Well, we're in a different paradigm now, and let's go to the next slide. I think there may be some information on there we want to look at. And the headline there is really what we want to talk about a bit here, which is the end of the grand car showroom. Many dealers, and we've heard a bit from Hank and I think Brian about online sales and home deliveries, and maybe also Russell was talking about this, Russell Geller, that is, not my partner, Russ McRory. And consumers have wanted this for a long period of time. There have been companies like TrueCar, Edmunds, et cetera, who have moved the industry a bit towards online sales. But now all dealers have, or many dealers, the majority of dealers have bulked up their web presence, enhanced their web capabilities, given themselves the ability even to do secure transactions online, to do a lot of the finance documentation online, et cetera. And that move to online sales and doing much of the process that people would otherwise spend hours in a dealership we think is probably here to stay. So in other words, the inconvenient part of a car transaction, consumers seem to prefer doing online, and dealers seem to have adapted to doing that online. Home delivery has a set of rules that we should probably talk about a little bit, but the point is, as we move to this more online sales dynamic, what will happen to the grand car showroom? And we think that it will shrink. The car showroom won't disappear. You know, what I think we'll see is something more along the lines of what Tesla has done. And I know Tesla is often a bad word to say in the car industry, but let's look at what they've done. They've created boutiques, but where much of the sales or leasing process happens online, even if it happens in the boutique, it happens at a kiosk where the customer engages with the sales process online. And that may, I don't know that traditional dealers will move all the way there, but as they move in that direction, the needs that OEMs are promoting, which is, you know, to have a Taj Mahal for each and every brand, exclusive facilities, et cetera, that is going to shrink and ultimately disappear. And we think they're going to be behind in that trajectory. By they, I mean the OEMs will be behind in that trajectory and will still continue to force dealers to at least try to coerce dealers into building what the OEMs want. Dealers, I think, have seen the light and see that to promote sales in this new paradigm, those grand car showrooms are not necessary. So we predict a lot of friction there. There are litigation matters brewing with a good size handful of OEMs, and I think the matter probably won't resolve without at least some litigation. Let's go to the next slide. So let's even go to the next slide. I think we've talked about this. So to comply with manufacturer facility requirements and the friction that will develop, we've looked at the various state laws that provide protections against building new facilities. And in every state, they're different. And I think Russ wanted to talk about the New York Dealer Act here and how that provides some protections for dealers who find themselves dealing with that friction with manufacturers.
Yep, thanks, Aaron. You know, as you all know, the manufacturer facility requirements take a lot of forms. It's not simply the new car showroom and the number of vehicles that can be displayed. It's the number of desks that the sales staff has. It's the number of service bays in the service department. It's always bigger and grander, and certain tile on the floor and lighting on the ceiling and fascia around the building and all of that. It's huge, and it's an ongoing expense. And just when the paint is dry in the old facility, they're already rolling out a new image program and have you online for that. I would urge dealers to be very careful in the future about signing on for those new programs. For the most part, as Aaron mentioned, the manufacturers have been backing off, but I think that's only temporary. We talked earlier about how profitable this is for dealers because of the supply and demand. Well, it's also because some manufacturers are greenlighting all the incentives. They're putting every dealer in the green for all the parts of their incentive programs. So dealers not only earning good grosses, they're also earning all the incentive and the margin money that they weren't before. So yes, everyone's making money now, but this is temporary, and based on what happened in 2009 and 2010, this is the calm before the storm, and the manufacturers will reimpose the requirements when all the dust settles. So, you know, all states are different. I just wanted to give a taste for the various protections that might be present in your state statute. Some state statutes have protections against renovations of a facility. For example, there's every 10 years is a typical protection in the state statute. Exclusivity is another area where many state statutes provide dealer protection. And a lot of dealer statutes also have a more nebulous kind of standard that the manufacturer has to show that the market will support the facility that they're requiring. So what I've noticed is a lot of states have a hole in their statutes, and this is when you all go back to your associations. You may want to raise this or take a look at it, where the protections only relate to a franchise requirement. In other words, where a manufacturer says, as a requirement for the franchise or to be renewed or to get your new 5-year agreement, you have to get a new facility. There are generally pretty robust protections for that because that's been around for a while. But now that manufacturers are tying incentive money and tying margin to facility, a lot of times the statutes have a gap. They don't protect for the scenario where it's not technically a franchise requirement, but so much money is tied to the facility that it becomes essentially a franchise requirement. And some states have that protection where if it's a program where money is tied to it, that the facility protections are there. And because we're looking at all of this, where do we need the big display room with all the displays? Do we need all the sales personnel? We have a BMW program where they're requiring dealers not only to have their existing sales personnel, but they also want dealers to hire what they call geniuses. So a whole new class of employees that BMW has required their dealers to employ to supposedly have a new like Apple Store type sales process for BMWs. All these employees are not going to be needed in going down the road. But when is BMW going to wake up to the fact that all these geniuses are not needed? I bet it won't be anytime soon. But they're tying money to that. Service stalls, as cars become less complicated, more electrified, better built, the service business will have to adjust to that. Next slide. So these are some of the issues Aaron and I have just spoken about. What I think dealers have to do is, again, Tesla is a 5-letter, 4-letter word, but I think dealers can take the best aspects of it and work it into that. I think Ken also talked about in terms of the F&I department using the iPad to sell F&I products. I think that is such a profitable part of the business. And if you want to compress and make the sales process more efficient, to have customers don't want to be spending a whole day in the dealership, that's a great way to do it. I mean, I was thinking back to when my parents bought the 1977 Buick Riviera. That was our first great car. But that was an all-day process in the dealership. We were there from the morning, and we picked up the car. It was dark. It was an all-day. And today, pre-COVID, while it's not an all-day process, it's a good chunk of the day. And I don't think customers are going to stand for that anymore. There is a role for the dealership. There is a role for delivering the car. There is a role for being belly to belly with the customer. But I think the time frame needs to be compressed. The F&I process needs to be compressed. And actually what we've seen is you can be more profitable by using the iPad method in the F&I department. I think Ken spoke to that before. Next slide. Metrics. The bet the franchise litigation traditionally was always obviously a termination. If you get a termination letter, that's a bet the franchise litigation. Add points if a new dealership is going into your market. That can be a bet the franchise litigation. What I've been seeing more and more in recent years is incentive money, bonus programs. There's so much money tied to that manufacturers have moved from traditional holdback into what I call earn back. That not getting that incentive money, that's oftentimes where your profit is in the new car department. And if you're not getting that incentive money, you're not profitable. And it's like, I call it whack-a-mole. There'll be a facility requirement one year, that'll be moved out, then there'll be a buying, off-lease purchase requirement. Then that'll be there for a couple of years, then it'll be a CSI requirement. Now it's a service effectiveness requirement. It's a toxic stew of whatever they can come up with next. And what we're seeing now, for example, is a move towards loyalty. Sales loyalty, service loyalty. But where is the market really moving? If we're moving towards a more internet remote type of sales, where you're not spending 8 hours in a dealership to get a car deal done, when you're not going to be going to the service department and sitting in a drinking a latte and sitting in a massage chair while your car gets serviced. If you're not having that experience as much anymore, how are you generating loyalty? And what does a loyalty metric really mean? Are the metrics really measuring what the customer experience is and what the dealership operational experience is? So the manufacturers are always behind. They're always a step behind, and they're measuring the dealers against metrics that really make no sense for the business. And the most current metrics, the loyalty metrics, I think are already, we're seeing are already outdated. They're already not measuring what's really going on. Next slide. So this is a market-based thing. I'll just deal with this very quickly. Brokers are huge in New York. In other words, those are basically third-party intermediaries that get supply from certain dealers, and they can put up a rooftop in another dealer's market and sell cars through that. And we talked about Tesla before. It's a 4-letter word. Brokers are a 4-letter word in certain markets like New York and South Florida. But when I look at it is there's an opportunity here for dealers where you can take the best aspects of what they do and turn it against them. Dealers have such innate advantages. They control the supply in almost every state. You have franchise dealers control the supply. A broker can only get cars if they get it from a dealer. Take the best aspects of the brokering model, which are a very online, compressed, efficient sales process, bring that into the dealership process, and the brokers won't be able to compete. Tesla won't be able to compete. If brokers are taking the best, if dealers take the best aspects of those sales, they can do it. In New York, the broker issue is very important because the model for sales objectives is based on proximity. Where's your nearest? If you're a Chrysler dealer, where are the other Chrysler dealers? How far are you away from them? And your market is set up, your objectives are set, your sales effectiveness is set, your sales volume objectives are set based on what they call the available opportunity in your market. But what if your nearest competitor is not the other Chrysler dealer, but a pop-up shop of a broker down the street from you, sourcing vehicles from states away? That is what we're seeing as the competition in a lot of the urban areas. Is not your nearest same line make competitor in a dealership, but in a pop-up store with no image requirements, no advertising requirements, none of the overhead that a dealer has. That becomes the local dealer's biggest competition. And the dealers who are supplying these brokers get the incentive money. They get the volume incentives. The dealer who's facing that competition has a big problem. None of these metrics take that into account. None of the incentive bonus objectives take this into account. This was a huge issue in New York with a New York court deciding that FCA's incentive program was illegal in large part because it didn't account for brokering. So all of these metrics, this is, Russell Geller is on with us now, the Beck Chevrolet case. What that case was about is the failure of these metrics to take into account local market conditions and consumer preferences, whether it's import bias, whether it's advertising, whether it's lease intent, whether a market is more lease intensive versus not lease intensive. Brokering is now an issue in a lot of markets, and none of these metrics take it into account. Next slide. So these are the key takeaways I think we've discussed. Aaron, did you have any further comments on the traditional franchise issues?
No, I think people can read these takeaways in the slide, but I think what people can expect are clashes over both allocation and incentives in the various ways that we've described and you've just gone over very specifically.
Excellent. At this time, and I'd like to, first of all, thank our panelists today, both the dealer and professional services panelists, to Russell, Brian, and Hank. Thank you so much for your time today and sharing your information, what's been going on in your respective areas. And to Bob, Ken, Russell, and Aaron as well for your insight. If there are any questions at this time, please feel free to utilize the chat feature in Zoom to ask those. Again, this presentation is being recorded, and I'm happy to provide that to you. In the chat, I've given an email address you can contact if you'd like for the recording to be sent to you. And at this point, I'll open it up to questions from the group. I think at this point, we may have addressed the questions throughout the webinar. I don't see anything coming in right now. So for the sake of time, I'll go ahead and excuse everyone, and everyone has my email address to contact me if there are any additional questions. I'd be happy to get them to the panelists as well.
Can I make one comment before we close?
Yes, Hank, absolutely.
Okay. One of the businesses and this has happened twice to me, and that's why I'm throwing it out there. One of the businesses that has really performed well in these bad environments for me is the dealer finance or buy here, pay here model, which I've been in business for over 25 years doing that. But both in 08, 09, and this year, those were my best performing business. This year, it's beating any one of my car dealerships. Profitability, and in 09, 10, it did the same thing, and it's really a good counter business to the dealership model. So I would recommend that to people. And the reason it is because it when the credit dries up, you're able to take on a better customer. Like we can take on a better customer right now than when we can when it's very competitive out there. And so we add a lot of real good customers and, make a lot of money.
Hey, Hank, is that, you may have just answered it, but is that a function of more volume of vehicles or purely the finance side of it?
Well, yeah, we do sell more cars. Right now it's kind of tough because we are, we're not sourcing the cars. Actually, here's one thing. We can source cars better than other people because I can pay more for a car because I can finance more of I can finance a higher dollar amount.
Right.
I'm not too concerned about the cost of the car. Although you got everything's within reason. But really what it is that the old saying that interest doesn't sleep. Well, you build up a portfolio of business, and as long as you're handling it professionally and taking care of it, it continues paying, in the bad times as well as the good.
You probably get pretty good yields on that paper too, I would guess.
Very good yields. What you find out is those customers, it's hard luck all the time for those customers. So when times come, it's no different than it is in the good times for them. They're much better at knowing how to get their bills paid, than a middle class person who all of a sudden, finds income lacking.
Yeah. Okay, thank you.
Ask a quick question to Bob. One thing I was sort of wondering is in the previous recessions,
I can't hear you, Russell.
Oh, you can't hear me? Am I unmuted?
You're unmuted. I can hear you.
Oh, I've got an unstable internet connection.
All right, then I guess I won't.
It's telling me I'm unstable. Okay, now I can hear. Unfortunately,
so
you can hear that too. Oh well.
Yeah, the question I had was, because you had those charts up about the recessions, and in the prior recessions there was some structural problem with the economy that
right.
precipitated it. Here, this was like something out of left field. At least in theory, the underlying economy was sound, and this was something external that just dumped on it. Is there? And usually I'm a bear, but maybe this is my bullish side coming out. Is if the underlying fundamentals were not the problem, is there a chance that this is that V recovery that we didn't see with the recessions? They were, I think, more of a long-term U recovery that you showed on your charts. Is there any hope for that, do you think?
Yeah, I would, my crystal ball says I would think so. the market, the stock market's strong, and even though that doesn't necessarily relate to closely held businesses, at least it does show you the inclination of people to buy securities versus debt, to jump out of the safe investments back into a riskier market. We've got inflation under control, and as long as that stays under control, very low interest rates. And if we can get the unemployment rate, if that can come back, then a lot of those fundamentals, I think, are there to support a more of a V-shaped recovery.
Fuel prices are low.
Fuel prices are low, yeah. The one scary thing to me is real estate again. I'm really concerned, and I'm not an economist, but I have to consider the economy doing valuations. The concern I have is real estate, just in general, overheated real estate. And interestingly, a commercial broker friend of mine and I were talking, and about a month and a half ago, he has 2 downtown Orlando large tenants he's representing in new leases, looking for new space. Right in the middle of this, both of those clients called him and said, cut our space in half. We don't need the space we needed before. And so I've got real concerns about commercial real estate too. And we saw what that did at the end of the 80s. And again, in 2007, 2008, 2009, there's a lot of cash flow associated with that could be taken out of the market in general. So those concern me a lot.
In Texas in the 80s, we called them see-throughs.
Yeah, see-through buildings. I worked for an S&L in a workout department. I sold a building in Austin for $35 a square foot.
Oh, yeah.
Yeah, Hank, it was interesting you mentioned the buy here, pay here. We just had a private equity group contact us yesterday, as a matter of fact, about trying to invest in buy here, pay here's and securitize the static pool of the loans and investing in the finance companies and all that, and trying to get some information. It's interesting you brought that up, and kind of timely, because I think that's a really good point.
Well, that's the biggest problem most people have is finding funding for all those loans. And luckily I've been in it long enough to where I have good relationships and I can get them all funded. But for somebody starting out, it's tough because go to a finance institution and say, hey, I want to do subprime lending. And they go, we're not going to lend you wholesale for that.
Right.
They don't understand.
In fact, we are currently working on a litigation case of a buy here, sell here group of one dealer to several different lots where the primary lender pulled the credit. And so they've had to go to self-financing. And of course that has impacted their deal flow. It's impacted, their collectability, just a whole bunch of different things, but you're beholden to that lender, just like you are in the new car business though.
It happened to me in 08.
Yeah.
Luckily I was able to beg somebody else to do it for me.
With dignity.
Yeah, with dignity.
What, Guido in New York?
Well, this is great. I really appreciate everybody's input in this.
Yeah, well, thank you for having us.
Yeah, thank you.
Thank
you. Items from the panel?
No, I think we're good.
All right, perfect. Thank you, gentlemen. Appreciate your time today. And thank you everyone for attending.
Everybody stay healthy.